basic, oh wait, this one's Modern Real Estate Practice, page 266. Overview. As economic conditions change, the forces of supply and demand create a rapidly evolving mortgage market. The change for today's real estate professionals is to maintain a working knowledge of the available financing options to help buyers and sellers reach their real estate goals. You have already learned about the types of loans and security options available to consumers. Here we consider the overall financial marketplace and refer to any loan secured by either a mortgage or a deed of trust as a mortgage loan. We will also look at the ways in which the federal government is involved in real estate financing. A mortgage that has no direct federal involvement, even though it may be made by a federally chartered lender, is called a conventional loan. Loans that have direct federal involvement include those insured by the Federal Housing Administration, FHA, or guaranteed by the U.S. Department of Veterans Affairs, VA. Introduction to the real estate financing market. The real estate financing market has the following three basic components. Government influences, primarily the Federal Reserve System, the mortgage market, and the secondary mortgage market. Under the umbrella of the monetary policy set by the Federal Reserve System, lenders that are part of the primary mortgage market originate loans that are bought, sold, and traded in the secondary mortgage market. Now we will look at the bigger picture, the financial marketplace in which those mortgages exist. The Federal Reserve System. The role of the Federal Reserve System, the Fed, is to maintain sound credit conditions, help counteract inflationary and deflationary trends, and create a favorable economic climate. The Federal Reserve System divides the country into 12 Federal Reserve districts, each served by a Federal Reserve Bank. All nationally chartered banks must join the Fed and purchase stock in its direct reserve banks. Qualified state chartered banks may also join the Fed. The Fed regulates the flow of money and interest rates in the marketplace through its member banks and other depository institutions. By controlling the rate charged for loans it makes to them, called the discount rate, as well their reserve requirements, the minimum level of funds that an institution must maintain. When the discount rate rises, interest rates on all sorts of loans will rise, making funding harder to obtain. When the discount rate is lowered, interest rates will go down, making borrowed funds easier to obtain, an incentive to businesses as well as home buyers. The Fed's reserve requirements place funds out of circulation. When reserve requirements are increased, lender solvency is improved, but funding is harder to obtain. The Fed acts on the open market to stimulate the economy at a time of recession by increasing the amount of money in circulation by buying treasury securities. Page 267. The Fed can also act to control inflation by decreasing the amount of money in circulation by selling treasury securities. The primary mortgage market. The primary mortgage market is made up of the lenders that originate mortgage loans. These lenders make money available directly to borrowers. From a borrower's point of view, a loan is a means of financing and expenditure. From a lender's point of view, a loan is an investment. All investors look for profitable returns on their investments. Income on a loan is realized from the following two sources: finance charges collected at closing, such as loan origination fees and discount points; reoccurring income, the interest collected during the term of the loan. Lenders can sell mortgage loans, which produces income to make more loans, and some lenders derive income from servicing loans for investors who have purchased the loans or servicing loans made by other mortgage lenders. Servicing a loan involves collecting payments, including taxes and insurance, if the borrower must maintain an impound account as part of the loan agreement; accounting, bookkeeping, preparing insurance and tax records; processing payments of taxes and insurance; and following up on a loan payment and delinquency. Major lenders of home mortgage and commercial property loans include the following: savings associations, also called thrifts, and commercial banks. These institutions are known as fiduciary lenders because of their fiduciary obligations to protect and preserve their depositors' funds. Mortgage loans are perceived as secure investments for generating income and enable these institutions to pay interest to their depositors. Fiduciary lenders are subject to the standards and regulations established by the Office of the Comptroller of the Currency, OCC, www.occ.gov. Deposits in insured institutions are covered up to the specified limit, currently $250,000 per depositor per account, by the Federal Deposit Insurance Corporation, FDIC, www.fdic.gov. Insurance companies. Insurance companies accumulate large sums of money from the premiums paid by their policyholders. While part of this money is held in reserve to satisfy claims and cover operating expenses, much of it is free to be invested in profit-earning enterprises such as large commercial real estate loans. Credit unions. Credit unions are cooperative organizations whose members place money in savings accounts. In the past, credit unions made only short-term consumer and home improvement loans. Now they routinely originate longer-term first and second mortgage and deed of trust loans. Federally chartered credit unions are regulated by the National Credit Union Association, NCUA, www.ncua.gov. NCUA insures deposits of up to $250,000 in all federal credit unions, as well as the majority of state chartered credit unions. Pension funds. Pension funds usually have large amounts of money available for investment. Because of the comparatively high yields and low risk offered by mortgages, pension funds have begun to participate actively in